We've always been dreaming of being rich, right? Who doesn't want to be anyway? Well, after watching our videos on the best finance book, Rich Dad, Poor Dad by Robert Kiyosaki and his cash flow quadrant, it's time to make you more money and for you also to become as wealthy as you wish in the future. So today, I'm going to share with you the psychology of wealth and the steps on how to be financially successful according to Robert Kiyosaki. The psychology of wealth and how to be wealthy according to Robert Kiyosaki. Number 1. Think rationally. Money has emotions. Simply see the stock market where fear and greed are in control. Stop thinking emotionally about money. Don't concentrate on how you feel, and especially don't concentrate on how you fear. Remember that failure is always one of your options. You'll eventually stop fretting about failing because you'll understand that you can always get back up. Humans are especially terrified of losing money, which is why they'll purchase a stock for $20 and then sell it at $30 out of concern for losing their gains when, if they had hung on for a longer period of time, the stock would have risen to $100 or more. The same folks will also continue to hang on to a $20 stock when it drops to $5 in the hopes that the value would increase. A successful trader or a business owner adopts the opposite strategy. They sell their stock and take their losses as soon as it begins to decline. They hang on to rising stocks until they're certain that they've reached their top. To put it another way, the secret to becoming a great investor is to operate logically and maintain an even keel regarding winning and losing. Number 2. Play Monopoly. Every time someone asks Kiyosaki how he became wealthy, he responds that he played Monopoly as a child. He learned from the game that the best strategy is to purchase 4 greenhouses before trading up for a huge red hotel. In his lifetime, the same principle applied. The author and his wife used their limited resources to purchase as many tiny residences as they could during a downturn in the housing market. They upgraded as the market improved. As a result, their lifestyle is now supported by the cash flow from their enormous red hotel, apartment buildings, and mini storage facilities. The thing that needs to alter in order to go from the left side of the cash flow quadrant to the right side is not what you do, but rather how you think. Working hard to get money to spend on things doesn't make you wealthy, it only makes you worn out. Kiyosaki spent years living simply and worked hard to accumulate assets rather than pay his debts. Kiyosaki advises those who are considering making the switch from the left side of the quadrant to the B or I side, which stands for business and investment respectively, to start small with the little green residences, take their time, and only advance to the big red hotels once they've earned some experience and confidence. Number 3. Knowing your assets and liabilities. The secret to becoming wealthy is developing risk management skills. To invest with your mind and not your eyes or your emotions, you need to have a financial education. For instance, having sound financial judgment entails understanding that a mortgage is a liability or an obligation that must be repaid rather than an asset. Your mortgage is a bank asset, not one that belongs to you. Your home is still not an asset if you pay off your mortgage because you have to maintain it and pay property taxes on it. Property can only be considered an asset if it produces a positive cash flow. Your savings, on the other hand, are an asset, but all your debts are liabilities. The majority of people think that gold is the ultimate asset, but as Kiyosaki's mentor from Rich Dad said, even gold is only an asset if you purchase it for less than you sell it for. Number 4. The risky side of the quadrant. The riskiest side of the quadrant is on the left, as an E, which stands for employee, because your financial security depends on another person. You're reliant on the judgment of others if you lack financial education. The quadrant's right side is the side that's safe. You don't have to worry about losing your job if you have a reliable system that generates income for you. If you need more money, you can expand the system and recruit more workers. Number 5. Be aware of the types of investors. Other investments like financing a college education or putting money aside for retirement don't actually belong in the I quadrant. The I quadrant, on the other hand, is about investments that produce income continuously during your working years. everyone should ideally invest some of their money in the I quadrant, where it can generate higher revenue. The fear of danger prevents many people from beginning to invest. By keeping their money in a bank or delegating the decision-making to a qualified investment manager, they wish to be safe. Yet the majority of these experts are salaried employees in the E quadrant. Wall Street is the only place, according to Warren Buffett, where people ride in a Rolls-Royce to obtain advice from those who take the subway. When you invest in a pension plan, you typically don't access your funds for several years. The person in the investor quadrant doesn't park their money. Instead, they immediately recover it and put it back to work. Today's stock market is dominated by E and S quadrant investors who are by nature security-oriented and believe in concepts like diversification. The preferable method, in Warren Buffett's opinion, is to focus on a small number of investments rather than diversity because, as he puts it, diversification is a way to not lose money rather than a way to earn money. If you're receiving value from our videos and would like to see more like this one, please like, subscribe, and ring that notification bell for more financial knowledge. Now let's move on. Here are Kiyosaki's 7 steps to financial success. Step 1. Mind your own business. Create your own personal financial statement first. Put down your financial goals for the next 5 years together with a more manageable objective for the next year. Make sure your objectives are doable. For instance, I intend to reduce my debt by $5,000 in 1 year and raise my monthly income from assets to $1,000 in 1 to 5 years. Create a balance sheet for yourself that includes all of your assets like savings, investments, real estate, obligations, and income statements that illustrate your current sources of income and expenses like mortgages, loans, and more. Step number 2. Manage your cash flow. Take a look at your financial statements from step 1. What cash flow quadrant does your current income fall under? In 5 years, where do you want the majority of it to come from? Create your 2-part cash flow management plan at this time. First, set aside a portion of each paycheck into a savings account designated for investments. Don't withdraw any more money from this account until you're prepared to invest it. Focus on paying off your consumer debt next. Employ no more than 1 or 2 credit cards each month, and make sure to pay off all new purchases each month. Find a way to make an extra $150 to $200 per month, and use that money to pay off the balance on one of your credit cards. Go on to the next card after you've paid off the first one. Do the same with your housing and car payments once all of your consumer debt has been repaid. Most people can accomplish this within 5 to 7 years. After you're debt-free, use the monthly payment you were making on your previous loan to fund investments that would increase your asset column. Step 3. Be educated. Find out what makes an asset and a liability different. A liability is something that causes money to flow out of your wallet, while an asset causes money to flow into your pocket. Spend 5 hours a week on at least one of the following activities: reading the Wall Street Journal and the business section of your local newspaper, listening to the financial news on the radio or television, reading financial websites, magazines, and newsletters, and attending investing and financial education seminars. Step 4. Try to learn to solve problems. Financially uneducated investors seek advice from experts on what to buy, whereas educated investors specialize in a particular area of problem solving. Bill Gates, for instance, excels at finding solutions to software marketing issues. Managing issues in the stock market and in business come naturally to Warren Buffett. In terms of resolving issues with apartment living, Kiyosaki and his wife are authorities. Continue your education. For instance, seek for sale signs in your neighborhood if you're interested in apartment living. Ask the agent how much the property's current rent and maintenance are, as well as what kinds of financing are offered by giving them a call. For each property, practice calculating the monthly cash flow statement. Attend financial lectures and seminars every week and read investment periodicals. Look at the businesses that stockbrokers suggest and think about setting up a trading account to make a few little bets. Speak with the local business brokers to find out what's available. Visit trade shows to learn about network marketing opportunities or nearby franchises. Step number 5. Look for possible great financial mentors. The advice given to Kiyosaki by his mentor Rich Dad was to concentrate on passive income and invest his time in accumulating assets that provide passive or long-term residual income. Choose your mentors wisely because most people who offer financial advice are confined to the E or S quadrants. Search for individuals in the business and investing quadrants. Step 6. Expect and grow with disappointment. When you experience a financial emergency, be prepared to be disappointed and have a mentor on call to assist. Be nice to yourself. If you punish yourself for every failure, you won't ever learn anything new. Above all, get going. Make real estate offers, sign up for a network marketing organization, or purchase stock after doing your study if you want to expand. Please keep in mind to take things slowly and understand that learning comes from making mistakes. Step 7. Trust and believe in yourself. Pay attention to your uncertainties and apprehensions before pursuing the truth. You might tell yourself, "I'm too wary to learn something new." But the truth is, if I don't learn something new, I'll be even more exhausted. And the deeper truth, if I learn something new, I'll get enthused about life again. So among these insights that we've mentioned, what do you think would help you change your financial future? Share your thoughts in the comments below. Don't forget to click that subscribe button, ring that notification bell, hit the like, and share this video with your money and business-minded friends. Till next time.